Picture this. A family walks into an open house. The price? $700,000. For a 3-bedroom home built in 1973. The paint is chipping. The roof leaks. The foundation has cracks you could fit your fist through. But there are 12 other families circling. Bidding wars. Cash offers. Waived inspections. And the realtor? Smiling. Because they know something you don't. This isn't a housing shortage. This is a manufactured crisis. And you're about to find out exactly who's pulling the strings, and why the entire system is rigged to collapse. For decades, you've been told the same story. Not enough houses. Too many buyers. Simple supply and demand. Build more homes, prices drop. Economics 101, right? Wrong. Dead wrong. Because while you've been waiting for prices to correct, while you've been saving for that down payment, while you've been told to be patient, the system has been weaponized against you. There are 6 lies. 6 carefully constructed narratives designed to hide the truth. And once you see them, you'll never look at real estate the same way again. But here's what terrifies the people at the top. You're starting to notice. The cracks are showing. The math isn't adding up. And when enough people wake up to what's really happening, the entire house of cards comes down. So let me ask you something, and I want you to really think about this. When was the last time you questioned why a basic human need, shelter, has become the single largest wealth transfer mechanism in modern history? Not if it's expensive, but why. Before we go any further, if you're tired of being lied to about the economy, about housing, about the real forces shaping your financial future, hit that subscribe button right now. This channel exists to cut through the noise and show you what's really happening. And if this video makes you angry, good. Leave a comment. Tell me I'm wrong. But stick around, because what's coming next will change everything you think you know about the housing market. Lie number 1. Zoning laws exist to protect communities. That's what they tell you. Height restrictions, density limits, setback requirements, minimum lot sizes, all designed to preserve neighborhood character, right? To prevent overcrowding, to maintain property values. Sounds reasonable. Sounds like good governance. But here's what they don't tell you. Zoning laws in most American cities aren't about protection. They're about exclusion. Artificial scarcity. Engineered shortage. Let me show you how deep this goes. In San Francisco, 73% of residential land is zoned exclusively for single-family homes. 73%. In one of the most expensive cities in the world, where the median home price is $1.4 million. You literally cannot build an apartment building on most of the land, even if you wanted to, even if demand is screaming for it. Los Angeles, 75% single-family zoning. Seattle, 65%. These aren't accidents. These are policy choices. But it gets worse. Because the people who benefit most from these restrictions? Existing homeowners. The ones who bought in decades ago, when prices were reasonable. They show up to city council meetings. They vote down every housing development. They hide behind words like neighborhood character and traffic concerns. But what they really mean is this. Keep supply tight. Keep my property value inflated. Keep the next generation locked out. And here's the mechanism they don't want you to understand. Every time a city blocks a housing development, every time they reject an upzoning proposal, every time they add another layer of bureaucratic delay, they're not protecting anything. They're extracting wealth. From renters, from young families, from anyone who doesn't already own. It's a transfer, straight from your paycheck into the equity of people who got there first. And the system is designed to make you think it's natural. Market forces, supply and demand. But there's nothing natural about it. In Tokyo, they have the opposite approach. Zoning is controlled at the national level. If you own land, you can build housing. No neighborhood veto power. No endless community meetings. And guess what happened? Tokyo's population is larger than New York and Los Angeles combined. But housing prices stayed stable for 20 years. Because they built supply. Real supply. Not the fake, drip-fed, artificially constrained supply we have in the West. Now I want you to think about your city. How many empty lots do you pass every day? How many low-slung commercial buildings taking up entire blocks? How many surface parking lots in the middle of urban centers? That's not scarcity. That's waste. Intentional waste. Because the people who control zoning policy benefit from keeping it that way. And this brings us to the second lie. Developers aren't building because construction is too expensive. You hear this everywhere. Labor costs. Material prices. Lumber shortages. Supply chain disruptions. All legitimate factors, sure. But they're not the real reason. Let me show you something. In Germany, construction costs per square foot are 30% lower than the United States. In Japan, 40% lower. Same materials. Same basic techniques. So what's different? Regulation. Permitting. Approval timelines. In Austin, Texas, it takes an average of 14 months to get a building permit approved. 14 months. Just for approval. Before a single shovel hits dirt. In Houston, which has some of the loosest zoning in America, 4 to 6 weeks. And what happened in Houston? They built housing. Lots of it. And prices stayed reasonable compared to other major metros. But here's the dirty secret. Big developers don't actually want faster permitting. They don't want easier approvals. Because the current system? It's a moat. A barrier to entry that keeps small competitors out. If you're a major national builder with armies of lawyers and lobbyists, you can navigate the bureaucracy. You can wait 14 months. You can absorb the costs. But a small developer? A local builder trying to put up a fourplex? They're crushed. They can't compete. And that's exactly the point. The big players collude with local governments to create a system that looks like it's about safety and quality. But really, it's about market control, limiting competition, keeping supply tight enough that prices stay elevated. And here's where it gets even more twisted. When cities do approve new housing, they load it up with requirements. Affordable housing mandates, parking minimums, green building certifications, impact fees, all of which sound great on paper. But every single one adds cost. And who pays that cost? Not the developer. You do. In higher rents. In higher purchase prices. The median cost to build a single-family home in California is $420,000. Before land. Before permits. Before profit. $420,000. And half of that, regulatory costs. Not lumber. Not labor. Fees. Delays. Mandates. This is engineered scarcity dressed up as policy. And the third lie is even more insidious. Institutional investors are just a small part of the market. You've seen the headlines. BlackRock buying up neighborhoods. Private equity turning homes into rental portfolios. And the response from the industry? They only own 2% of single-family homes. It's not a big deal. Stop panicking. But that statistic, it's a magic trick. Because they're not buying randomly. They're buying strategically. In specific markets. Specific zip codes. Specific price ranges. Let me break it down. In Phoenix, institutional investors bought 24% of all homes sold in 2021. In Atlanta, 32%. In Charlotte, 27%. These aren't small players. These are Wall Street-backed funds with billions in capital, competing directly with families, outbidding you with cash offers, waiving inspections, closing in 7 days. And here's what makes this so dangerous. They're not buying to sell. They're buying to hold, to rent, to financialize. They bundle these homes into rental-backed securities. They sell them to pension funds and sovereign wealth funds, which means the housing stock is being permanently removed from the ownership market, converted into a yield-generating asset class. And once that happens, it doesn't come back, because the incentive structure changes. A family buys a home, lives in it, maybe sells in 10 years. A fund buys a home, rents it out indefinitely, and uses it as collateral for more borrowing. It's a one-way valve, ownership to rental. And the more homes they buy, the tighter the market gets for everyone else, which drives prices up, which makes their existing portfolio more valuable, which lets them borrow more, which lets them buy more. It's a feedback loop, and you're on the wrong side of it. Now, the industry will tell you this is good. More rental supply, more flexibility for workers, more professional management. But let's be honest about what's really happening. Wealth extraction. They're not providing a service. They're inserting themselves as a permanent middleman between you and shelter, collecting rent forever. And the data backs this up. In neighborhoods where institutional investors own more than 20% of the housing stock, rents are 18% higher than comparable neighborhoods. 18%. Not because the homes are better. Not because the service is superior, but because they can. Because they have pricing power. Because they've cornered the market. And here's the kicker. When the market crashes, and it will, these funds don't go bankrupt. They get bailouts. They get liquidity injections. They get backstops from the Federal Reserve. You lose your home. They buy it at a discount. This isn't capitalism. This is extraction. Lie number 4. Demographics will solve the housing shortage. This one's subtle. And it's everywhere. The narrative goes like this. Baby boomers are aging. They're going to downsize. Or die. And when they do, all those homes will flood the market. Supply will surge. Prices will crash. Problem solved. Just wait it out. Sounds logical, right? Except it's completely wrong. Here's why. Baby boomers aren't selling. They're staying. Aging in place. Because they've been told their entire lives that home equity is their retirement plan. Reverse mortgages let them extract cash without selling. Low property taxes from Prop 13 style laws make it cheap to stay. And emotionally, they're attached. This is the house they raised their kids in. The neighborhood they know. They're not leaving. Even when it makes financial sense to downsize, they don't. And here's the data. The average age of a homeowner in the U.S. is now 56 years old. 56. Up from 49 just 20 years ago. Older homeowners are holding onto their homes longer than any generation in history. The turnover rate, the percentage of homes that change hands each year, is at a 40-year low. 4.1%. Meaning the average home is now held for 24 years before it's sold. So this idea that a wave of boomer homes is coming? It's fantasy. And even if they did sell, their kids inherit them. Or they sell to investors, who convert them to rentals. The homes don't magically become affordable starter homes for young families. They get financialized, pulled into portfolios, rented out. Or they get torn down and replaced with luxury builds targeting the top 10% of earners. Because that's where the margin is. There's no profit in affordable housing. Not in this system. But here's the even darker twist. The demographic narrative serves a purpose. It keeps you waiting. Keeps you thinking the correction is just around the corner. Keeps you from demanding policy changes. Because if the problem will solve itself, why do anything? Just be patient. Keep renting. Keep saving. Your time will come. Except it won't. Because the game is rigged. And the fifth lie? That's where the real fragility lives. There's no shadow inventory. Shadow inventory. That's the term for homes that should be on the market, but aren't. Vacant homes. Second homes. Investment properties sitting empty. Homes in foreclosure that banks are slow walking. Homes held by LLCs and trusts that never list. The official statistics say there's a housing shortage. Not enough supply to meet demand. But drive through any major city. Count the dark windows. The overgrown lawns. The "for rent" signs that never come down. There are 17 million vacant homes in the United States right now. 17 million. That's more than enough to house every homeless person in America 16 times over. But you're told there's a shortage. How does that math work? Let me show you where these homes are hiding. First, vacation homes. There are 7.5 million second homes in the U.S. Most of them sit empty 10 months a year. Aspen, Lake Tahoe, Miami Beach. Manhattan penthouses owned by foreign oligarchs who visit twice a year. These homes are wealth storage, not housing. They're appreciating assets, kept off the market intentionally to avoid taxes, scrutiny, or depreciation from where. Second, investment properties held by LLCs. Millions of single-family homes owned by private investors. Not institutions. Just individuals who bought rentals over the years. And here's what happens. They're waiting. Waiting for the market to peak. Waiting for the right buyer. Sitting on equity, taking the tax write-offs, in no hurry to sell. Because the carrying cost is low and the appreciation is high. Third, zombie foreclosures. Homes that entered the foreclosure process but never completed. The bank started the paperwork, the family moved out, but the bank never took possession. So the home sits, rotting, in legal limbo. There are over 200,000 of these across the country, concentrated in the Midwest and Rust Belt. Not because there's no demand, but because it's not profitable for banks to finish the process and take the loss. So they just wait, and the home decays. Fourth, new builds held off the market. Developers finish a project, but instead of selling all the units immediately, they dribble them out. 5 units a month. 10 units a quarter. Why? To avoid flooding their own market. To keep prices elevated. It's called shadow supply. And it's a deliberate strategy. Better to hold 10 units empty for 6 months than to sell them all at once and crash the local comps. Now add it all up. Vacation homes. Investor holds. Zombie foreclosures. Developer inventory. You're looking at millions of homes that could be on the market, but aren't. And the system is designed to keep it that way. Because scarcity is profitable. Abundance is not. But here's where it all comes together. The sixth lie. The lie that holds the entire structure in place. Mortgage debt is safe because home prices always go up. This is the foundational myth of the modern housing market. The idea that real estate is a one-way bet. That prices may dip temporarily, but long-term, they always recover. Always appreciate. And because of that, it's safe to borrow. Safe to leverage. Safe to take on a 30-year debt obligation that's 3 to 5 times your annual income. But let me show you what's really happening beneath the surface. The average American mortgage debt is $240,000. The median household income is $74,000. That's a 3-to-1 debt-to-income ratio. Historically, that's high. But it's been normalized. Because rates were low. Because housing was seen as safe. Because everyone was doing it. But here's the crack in the foundation. Most of that debt is floating on the assumption of continued appreciation. If your home is worth $500,000 today, and you owe $240,000, you have $260,000 in equity. You're fine. But what happens when the market turns? When prices drop 10%, 20%, suddenly you owe more than it's worth. You're underwater. And if you need to sell, for a job, a divorce, a medical emergency, you can't. You're trapped. And here's the systemic risk no one's talking about. Mortgage-backed securities. Remember 2008? The entire global financial system nearly collapsed because mortgage debt was bundled, sliced, rated AAA, and sold to pension funds and banks worldwide. When housing prices dropped, those securities became toxic. And the contagion spread. Well, guess what? We're doing it again. There are currently $12 trillion in mortgage-backed securities in the U.S. market. $12 trillion. Held by banks, insurance companies, foreign governments, your retirement fund. All of it based on the assumption that housing prices stay stable or go up. But the cracks are forming. Delinquency rates are rising. Quietly. Slowly. Not enough to make headlines. But enough to worry the people paying attention. In subprime auto loans, which often serve as a leading indicator for mortgage stress, delinquencies are at the highest level since 2009. Credit card debt is at record highs. Savings rates are at record lows. People are stretched. And when they're stretched, the mortgage payment is the last thing they stop paying. Because losing your home is the ultimate failure. So they pay the mortgage. And they stop paying everything else. Until they can't. And then the whole thing unravels. But here's what makes this different from 2008. Back then, the problem was subprime borrowers. People who shouldn't have qualified in the first place. Liar loans. No-doc mortgages. Ninja loans. No income, no job, no assets. The system was obviously corrupt. And when it broke, everyone saw it coming in hindsight. But today, the borrowers are qualified. They have good credit scores, stable jobs, down payments. On paper, everything looks fine. But the debt load is just as high. The leverage is just as extreme. And the assumption of continued appreciation is just as fragile. The difference is, this time, it's hidden, normalized, baked into the system. And when it breaks, it won't be blamed on reckless borrowers. It'll be blamed on unforeseen circumstances. A recession, a geopolitical crisis, a black swan event. But the truth is simpler. The system was designed to break. Because breaking is profitable. For the right people. So let's talk about who profits when this collapses. First, the banks. They hold the mortgages. And when borrowers default, they take possession of the homes. Then they sell them to investors at a discount. Or hold them as rental properties through subsidiaries. Either way, they win. Second, private equity. When the market crashes, they have cash. They can buy at the bottom. Scoop up distressed properties. Wait for the recovery. And sell or rent at a massive profit. Third, the government. Not directly, but through control. Because every crisis justifies more intervention, more regulation, more programs, more debt, and more power. The people who lose. Middle-class families. First-time buyers. Anyone who bought at the peak thinking they were building wealth. Renters who were one paycheck away from stability. Retirees who were counting on home equity. They get wiped out. And the wealth transfers up. Again. Now let me show you where this is going to hit first. Because it's not going to be uniform. Some markets are going to collapse. Others will stay relatively stable. And knowing the difference could save you. The most vulnerable markets share three characteristics. 1. High price-to-income ratios. 2. High investor ownership. 3. Economic dependence on a single industry. Let's start with price-to-income. In a healthy market, the median home price should be about 3 to 4 times the median household income. That's sustainable. That's what history shows as stable. But look at these numbers. San Francisco, median home price $1.4 million, median income $130,000. That's a ratio of 10 to 1. Los Angeles, median price $900,000, median income $76,000. Ratio of 12 to 1. San Diego, Seattle, Denver, Austin, all sitting at 7 to 1 or higher. These markets are mathematically unsustainable. The only thing holding them up is cheap debt and speculative appreciation. When rates stay elevated, and they will. And when layoffs hit, and they are, these markets will crater. Not slowly, fast, because the fundamentals were never there. Second, investor ownership. I already talked about institutional investors, but even beyond them, markets with high percentages of non-owner-occupied homes are fragile, because investors sell faster than families. They're not emotionally attached. They're watching spreadsheets. And when the ROI turns negative, they dump. Phoenix, Las Vegas, Atlanta, Charlotte, all have investor ownership rates above 20% in certain zip codes. When the selling starts, it cascades. More supply hits the market. Prices drop. More investors sell to cut losses. Prices drop more. It's a doom loop, and it happens fast. Third, economic concentration. Cities that depend on one industry are time bombs. Austin is tech. If the tech layoffs continue, and they will, demand collapses. Denver is energy and tech. Same risk. Seattle is tech and aerospace. Miami is finance and real estate speculation. When the industry wobbles, the housing market doesn't just slow down, it implodes. Because the high earners leave, and they were the only ones who could afford the prices in the first place. So if you're in one of these markets, you need to be thinking about your exit strategy. Not in 5 years. Because when the shift happens, liquidity disappears. You won't be able to sell at any price. And if you're sitting on a mortgage that's 80% of your home's value, you're stuck. But here's the twist. There are markets that will hold. Places where fundamentals are actually strong. Where prices are reasonable relative to incomes. Where the local economy is diversified. Where there's real demand from real people. The Midwest. Parts of the South. Smaller metros that never had the speculative run-up. Pittsburgh, Cleveland, Indianapolis, Kansas City. These places aren't sexy. They're not going to make you rich, but they're stable. And in the coming years, stability is going to be worth more than speculation. Now let's talk about the policy response. Because this isn't going to collapse in a vacuum. Governments will intervene. They always do. The question is, how? And who benefits? History gives us clues. After 2008, the response was bailouts. Banks got rescued. Homeowners got loan modifications. Some of them. But mostly, the system got reinflated. Quantitative easing. Zero interest rates. Asset purchases. The Fed pumped trillions into the system to prop up housing prices. It worked. For the banks. For investors. But it locked out an entire generation of buyers. Because prices never actually corrected. They were artificially supported. And now we're living with the consequences. So what happens this time? Option 1. They let it crash. No bailouts. No interventions. Prices fall to natural levels. Housing becomes affordable again. But the pain is widespread. Defaults. Foreclosures. Bank failures. Recession. This is the purge scenario. And politically, it's almost impossible. Because the majority of voters are homeowners. And they will not accept policies that crash their home values. So option 1 is unlikely. Option 2. They reinflate. Again. Lower rates. More liquidity. Government-backed mortgages with even looser standards. First-time buyer credits. Subsidies. Anything to keep the market propped up. This kicks the can down the road. Keeps the system limping along. But it makes the inevitable crash even worse. Because the debt keeps growing. The leverage keeps increasing. And the distortions get deeper. Option 3. And this is the one I think is most likely. They financialize further. Rent control. Public housing expansion. Government as landlord. They don't let prices crash. But they also don't make ownership accessible. Instead, They normalize renting. Permanently. You'll own nothing. And they'll tell you it's freedom, flexibility, mobility. But really, it's extraction. You pay rent forever. To private equity, to the government, to whoever owns the asset. And you build zero equity, zero wealth, zero security. This is the future they're building. And the housing crisis is the excuse. So what do you do? If you're renting, and you're trying to decide whether to buy, here's the brutal truth. In most major markets right now, you're better off waiting. Not because prices will definitely crash, but because the risk-reward is terrible. If you buy at the peak, and prices drop even 10%, you've just locked yourself into years of negative equity. And if rates stay high, your payment is massive. But if you wait, and the market corrects, you buy at a better price, with less risk. Yes, you're paying rent in the meantime, but rent is the maximum you'll pay each month. A mortgage is the minimum. Once you factor in maintenance, taxes, insurance, and the opportunity cost of your down payment, renting is often cheaper, especially in overheated markets. But here's the key. If you do buy in a stable market, with strong fundamentals, with a price-to-income ratio under 5, with a diversified economy, with low investor ownership, and buy with a fixed-rate mortgage. Lock in your rate, because if inflation stays elevated and rates stay high, your fixed payment becomes cheaper in real terms over time. But if you're already a homeowner, especially if you bought in the last 3 years, you need to be honest about your position. If you're in an overheated market and you have significant equity, consider taking chips off the table. Sell, rent for a while, wait for the correction, then buy back in. Yes, you'll pay taxes on the gain, but if the market drops 30%, you just saved yourself $100,000 or more. And if you're underwater, or close to it, start planning now. Cut expenses. Build cash reserves. Do not take on more debt, because when the pressure hits, you want options, and options require liquidity. Now let's zoom out, because this isn't just about housing. This is about the entire economic system. Housing is the largest asset class in the world. Residential real estate is worth over $320 trillion globally. More than all stocks. More than all bonds. More than all gold. It's the foundation of middle-class wealth. The collateral for the banking system. The mechanism for generational wealth transfer. And it's all built on debt. Mortgages. Leverage. The assumption that prices go up. But what happens when that assumption breaks? When the collateral loses value. When the debt can't be serviced. The whole system seizes. Banks stop lending. Consumers stop spending. Businesses stop hiring. It's not just a housing crash. It's a systemic crisis. And every major economic collapse in modern history has had real estate at the center. The Great Depression started with a real estate bubble. The S&L crisis of the 80s, real estate. The Japanese lost decades, real estate. The 2008 financial crisis, real estate. And the next one. It's already being written. The signs are everywhere. Rising defaults. Falling transaction volumes. Inventory building. Price cuts spreading. Layoffs in real estate and construction. But the headlines haven't caught up yet. Because the industry has every incentive to keep selling the dream. Realtors make commissions on volume. Banks make money on originations. Builders make money on new construction. Private equity makes money on acquisitions. Everyone in the system profits from keeping you believing that housing is safe. That prices always go up. That you're missing out if you don't buy now. But you're not missing out. You're being smart. You're seeing through the lies. And that's dangerous. To them. Because if enough people stop buying, If enough people demand policy changes, if enough people refuse to play the game, the whole extraction mechanism breaks down. And that's exactly what needs to happen. So here's the bigger picture. The housing market isn't broken. It's working exactly as designed. To transfer wealth, to extract value, to keep the majority renting and the minority owning. The 6 lies I've shown you aren't accidents. They're features. Zoning laws create artificial scarcity. Regulatory costs keep competition out. Institutional investors financialize the stock. Demographic myths keep you waiting. Shadow inventory stays hidden. And mortgage debt keeps you leveraged. Each lie serves a purpose. And together, they've created a system that's unstable by design. Because instability creates opportunity. For those with capital. For those with access. For those who know when to buy and when to sell. But for everyone else, it's a trap. And the trap is tightening. Because here's what's coming. In the next 12 to 18 months, we're going to see the cracks widen. More defaults. More layoffs. More inventory hitting the market. Prices will start to fall. Slowly at first. Then faster. And the narrative will shift. From buy now or be priced out forever. To housing is a bad investment. And both narratives will be wrong. Because housing isn't an investment. It's shelter. It's a place to live. And the fact that we've turned it into a speculative asset class, that we've financialized basic human needs, that we've allowed Wall Street to turn neighborhoods into yield-generating portfolios, that's the real crisis. Not the price. The system. And until we fix the system, the cycle will repeat. Boom. Bust. Bailout. Boom. Bust. Bailout. And each time, wealth concentrates further. The middle class shrinks. Ownership becomes more distant. And the dream dies a little more. But it doesn't have to be this way. Other countries have figured this out. Singapore has public housing that's actually high quality, where 80% of the population lives in government-built flats. And they own them. They build equity. They have stability. Vienna has social housing that's mixed income, where even middle-class families live in beautiful, well-maintained buildings, at affordable rents, with security. Japan has flexible zoning, where supply meets demand, where housing is abundant and affordable. These aren't socialist utopias. They're pragmatic policy choices. Choices that prioritize people over profit, shelter over speculation, stability over extraction. And we could do the same. Upzone our cities. Tax vacant properties. Ban corporate ownership of single-family homes. Build social housing. Cap rent increases. Forgive mortgage debt for underwater homeowners. These solutions exist. The political will doesn't. Because the people who benefit from the current system own the politicians, fund the campaigns, write the laws. And they will fight to keep it this way. Until they can't. Until the collapse forces change. And that's where we are. On the edge. The housing market is a systemic time bomb. And the fuse is lit. You can see it in the data. You can feel it in the culture. You can hear it in the conversations people are finally starting to have. About fairness. About access. About whether this is really the best we can do. And the answer is no. We can do better. We must do better. Because housing is foundational. To families. To communities. To stability. And when housing becomes unaffordable, everything else breaks. Health, education, mental well-being, social cohesion. It all falls apart. And we're watching it happen. In real time. But here's the thing. You're not powerless. You can opt out. You can refuse to buy into a broken market. You can demand policy change. You can vote for leaders who prioritize housing affordability. You can organize with your neighbors. You can build alternative models. Co-housing, community land trusts, cooperative ownership. The tools exist. The models exist. What's missing is the collective will to deploy them. And that starts with awareness. With seeing the lies for what they are. With understanding the mechanism. With refusing to accept the narrative that this is just how things are. Because it's not. This is how things have been designed. And what's designed can be redesigned. So let me leave you with this. The housing market is going to crash. Maybe not tomorrow. Maybe not this year. But it's coming. And when it does, the question isn't whether you'll be affected. You will. The question is whether you'll be prepared. Whether you'll have liquidity. Whether you'll have options. Whether you'll be positioned to take advantage of the reset. Or whether you'll be crushed by it. That choice is yours. But you have to make it now. Before the window closes. Before the crash comes. Before the trap snaps shut. Because the system isn't going to save you. The government isn't going to save you. The market isn't going to save you. You have to save yourself. And the first step is seeing clearly. The 6 supply lies aren't just misleading. They're weapons. Designed to keep you confused. Keep you compliant. Keep you playing a game you can't win. But now you know. You've seen the zoning scam. The regulatory moat. The institutional takeover. The demographic myth. The shadow inventory. The mortgage fragility. You've seen how it all connects. How each piece reinforces the others. How the system is designed to extract. And how it's designed to break. Now the question is, what are you going to do about it? Are you going to keep playing along? Keep waiting for prices to come down? Keep believing the narrative? Or are you going to act? Make different choices. Build different systems. Demand different outcomes. The collapse is coming. But collapse is also opportunity. For those who see it. For those who prepare. For those who refuse to be victims. So stay sharp. Stay liquid. Stay informed. And whatever you do, don't buy the lies. Because the truth is right in front of you. The housing market is a systemic time bomb. And when it explodes, the world is going to look very different. Make sure you're ready. The elites want you to believe this is just how markets work. That you should be grateful for the chance to take on a lifetime of debt for a depreciating asset in an overpriced market. But you've seen behind the curtain now. You know the game is rigged. And knowledge is the first step toward freedom. If this video opened your eyes, if it made you angry, if it made you think twice about the biggest financial decision of your life, then share it. Send it to someone who's about to buy. Someone who's struggling with rent. Someone who thinks they're alone in this fight. Because they're not. We're all in this together. And the more people who wake up to these lies, the harder it becomes for the system to keep running. Subscribe to this channel if you want to keep seeing the truth. The uncomfortable truth. The truth they don't want you to know. Comment below and tell me which lie shocked you the most. Or tell me I'm wrong. I'll read every single one. Because this conversation matters. Your future matters. And together, we can build something better than this rigged game. Thank you for watching. Stay vigilant. Stay skeptical. And I'll see you in the next one.